Hello. Today we are going to be looking at forecasting financial statements. By the end of this video, you will be able to use net new financing in a pro forma financial statement. This is as part of FIN300 Chapter 18 review. This is a two-part question, and this is part 1 of 2. Let's get into it with some review. In Chapter 18, we learned about the net new financing equation. Net new financing equals projected assets minus the total of projected liabilities and projected equity. This is reminiscent of the basic accounting equation, which states that the left side, assets, must be equal to the right side, the total of liabilities and equity. In the case of net new financing, if we have a positive number, in other words, if there are more projected assets, we need to raise funds to pay for these projected assets. This amount is called the plug. On the other hand, if we have a negative number or more liabilities and equity, we need to find uses for the extra cash that we project to have on hand. Chapter 18 also talks about pro forma analysis, which is an educated guess of the company's potential financial position based on historical financial information. Let's look at problem 18.2 from our Fundamentals of Corporate Finance textbook. For the next fiscal year, you forecast net income of $50,000 and ending assets of $500,000. Your firm's payout ratio is 10%. Your beginning shareholders' equity is $300,000, and your beginning total liabilities are $120,000. Your non-debt liabilities, such as accounts payable, are forecasted to increase by $10,000. What is your net new financing needed for next year? We have the following information. The company's payout ratio is 10%. This means that its retention rate is the inverse of that, or 90%. At the beginning of the year, we have $300,000 in shareholders' equity, or SE for short. We also have $120,000 of total liabilities, TL for short. At the end of the year, we forecast to have $50,000 in net income, NI for short, and $500,000 in assets. During the year, our shareholders' equity increases by $45,000. Why? Well, that's because our 90% retention rate is applied to our $50,000 of net income. And 90% of 50K, or 50K times 90%, equals $45,000, which we will add to our shareholders' equity through means of retained earnings. We also have a $10,000 increase in non-debt liabilities, NDL for short. This is given to us in the text. This means that at the end of the year, we forecast to have $345,000 of shareholders' equity, which is of course the combination of the beginning $300,000 and the $45,000 increase in retained earnings. We also forecast to have $130,000 in total liabilities because, of course, non-debt liabilities are a form of liability, and they will be added to our $120,000 of existing total liabilities. Now we apply the net new financing formula. To recall, net new financing equals projected assets minus, in brackets, projected liabilities and equity. So in our case, that means $500,000 in projected assets minus the sum of $130,000, which is our projected liabilities, and $345,000, which is our projected equity. To simplify, that becomes $500,000 minus $475,000, which equals $25,000 in net new financing, or NNF for short. And that is our final answer to problem 18.2. To get a further understanding of forecasting financial statements, try Chapter 18, problems 4 to 7 in your textbook or MyLab study plan. In summary, remember that since our final answer is a positive number, $25,000, we have more projected assets. This means we need to raise funds by equity, debt, or both to fill the shortage. This explains why this amount is called the plug. Now we have our answer to problem 18.2. Our total amount of net new financing needed is $25,000. But how do we plan to raise that money? Problem 18.3 answers that, and we will do that in part 2 of this video. Thank you for taking the time to watch this video. Feel free to connect with the Academic Success Center on social media. We're on YouTube. If you search for RU Connected Learning, on Instagram and Facebook at TRSMASC, and on Twitter at TRSM_ASC.